The world's most successful investor, Warren Buffett, is sitting on a mountain of cash, $189 billion to be exact. At the same time, he's selling off massive chunks of his prized Apple stock faster than you can say iPhone. Buffett's favorite market indicator is flashing red, warning of a potential 40% market crash. But will it happen? Let's find out. Buffett's big moves. Buffett's company, Berkshire Hathaway, has been making some eyebrow-raising moves that have caught the financial world's eye. First up, let me tell you about Apple. For years, Buffett has sung the praises of the tech giant, even calling it one of the four giants of his business empire. But in a surprising twist, Berkshire Hathaway has been steadily trimming its Apple stake over the past year. In the second quarter of 2023 alone, they sold over 389 million Apple shares. That's nearly half of their holdings in the iPhone maker. But Apple isn't the only stock Buffett's been selling. He's also been reducing positions in Bank of America and the Chinese EV maker BYD. Meanwhile, he's been making very few new purchases. It's like watching a master chess player carefully moving his pieces off the board, one by one. Now here's where things get really interesting. All this selling has led to Berkshire's cash reserves skyrocketing to a mind-boggling $189 billion. That's not just a lot of money, it's a new record for the company. To put that in perspective, that's more cash than the GDP of many countries. But why would Buffett, a man famous for his buy and hold strategy, suddenly start hoarding cash like it's going out of style? Well, that's the million-dollar question, or in this case, the $189 billion question. Some analysts believe Buffett is preparing for a major market downturn. After all, one of Buffett's most famous sayings is, "Be fearful when others are greedy, and greedy when others are fearful." Right now, with the stock market hitting all-time highs, it seems Buffett might be getting a little fearful. But before we jump to conclusions, let's get into what might be driving Buffett's decisions. The Buffett Indicator. Despite its name, Buffett didn't create this metric, but he has called it probably the best single measure of where valuations stand at any given moment. So what exactly is the Buffett Indicator? It's actually pretty simple. You take the total market capitalization of all publicly traded stocks in a country and divide it by that country's gross domestic product, or GDP. The idea is that over the long term, the stock market should reflect the overall economy. Here's where things get a bit scary. The Buffett indicator for the U.S. stock market is sitting at a whopping 195%. In other words, the value of all stocks is nearly double the entire U.S. economy. To put that in perspective, during the dot-com bubble of 2000, this indicator peaked at about 145%. We all know how that ended. Historically, when this indicator gets above 100%, it's considered overvalued. Above 140%, that's bubble territory. At 195%, we're in uncharted waters. Buffett isn't just aware of this indicator, he's acting on it. By selling stocks and stockpiling cash, he's essentially saying, "I think these prices are too high and I'm waiting for better deals." Now, does this mean a crash is definitely coming? Not necessarily. The market can stay irrational longer than you can stay solvent, as the saying goes. However, it does suggest that Buffett sees the current market as overvalued and potentially risky. The cash conundrum. Let's circle back to that massive pile of cash Berkshire Hathaway is sitting on. $189 billion is a lot of money to have just lying around, especially for someone like Buffett, who famously said, "Cash is a bad investment over time." So why is Buffett, the man who built his fortune by investing in great businesses, suddenly hoarding cash like an ancient dragon guarding its treasure? Well, there are a few potential reasons. First, having a large cash reserve gives Berkshire the flexibility to act quickly when opportunities arise. If the market does take a nosedive, Buffett will be ready to swoop in and buy quality companies at bargain prices. Second, In times of economic uncertainty, cash can provide a safety net. With rising interest rates, inflation concerns, and geopolitical tensions, having a solid cash position can help weather any potential storms. But there's another, more concerning possibility. Buffett might be seeing something on the horizon that has him battening down the hatches. Remember, this is a man who's lived through numerous market cycles and economic crises. He's got a sixth sense for sniffing out trouble. In fact, Buffett's been here before. Back in 2007, just before the financial crisis hit, Berkshire's cash pile had grown to what was then a record $44 billion. We all know what happened next. The market crashed, and Buffett was able to make some incredible deals, including a $5 billion investment in Goldman Sachs that paid off handsomely. So, is history repeating itself? Is Buffett preparing for another major market downturn? It's certainly possible. But before we start panicking and selling everything, let's look at some other indicators that might support or contradict this theory. Market valuations. After all, if Buffett is right and we're heading for a crash, we should see some signs in the overall market, right? Well, folks, the signs are there, and they're flashing brighter than a Vegas casino. Let's start with the P/E ratio of the S&P 500. It's sitting at around 30, well above the historical average of 15 to 16. In simple terms, stocks are expensive right now. Really expensive. But it's not just the P/E ratio that's raising eyebrows. The Shiller P/E ratio, which takes into account earnings over the past 10 years to smooth out economic cycles, is even more alarming. It's currently above 30, a level it's only reached 3 times in the last century. The other 2 times? Right before the 1929 crash and the dot-com bubble burst in 2000. Yikes. And let's not forget about the tech sector. Companies like Apple, Amazon, and Microsoft have been driving the market to new heights, but their valuations are getting into nosebleed territory. We're talking P/E ratios of 50, 60, or even 100 for some of these companies. It's like watching a game of financial Jenga. And Buffett might be quietly stepping away from the table before the whole thing comes crashing down. Just because stocks are expensive doesn't mean they can't get more expensive. As the famous economist John Maynard Keynes once said, "The market can remain irrational longer than you can remain solvent." So, while these high valuations are certainly a cause for concern, they're not a guarantee of an imminent crash. The interest rate factor. Now let's talk about something that's been on every investor's mind lately: interest rates. For years, we've been living in a world of near zero interest rates. But friends, winter is coming. The Federal Reserve has made it clear that interest rates are going up, and they're going up fast. Now you might be thinking, so what? How does this connect to a potential market crash? Well, let me break it down for you. Low interest rates have been like rocket fuel for the stock market. They've made borrowing cheap, encouraged risk-taking, and pushed investors into stocks in search of returns. But now, the Fed's taking away the punch bowl. Higher interest rates makes borrowing more expensive, which can slow down economic growth. They also make safer investments like bonds more attractive, potentially leading to money flowing out of stocks. Here's where Buffett comes in. He's seen this movie before, and he knows how it ends. Higher interest rates can lead to slower economic growth, lower corporate profits, and ultimately, lower stock prices. By selling stocks and hoarding cash, Buffett positioned himself to take advantage of any market turbulence that might result from rising rates. But it's not just about being defensive. Remember that massive cash pile we talked about earlier? Well, with interest rates rising, that cash is suddenly worth a lot more. It's like Buffett's got a giant piggy bank that's getting fuller by the day. The economic landscape. After all, the stock market doesn't exist in a vacuum. It's deeply intertwined with the overall economy. And right now, the economic picture is, well, let's just say it's complicated. On the one hand, we've seen a strong recovery from the pandemic-induced recession. Unemployment is down, consumer spending is up, and GDP growth has been robust. Sounds great, right? But dig a little deeper, and you will start to see some cracks in the foundation. Inflation has been running hot, supply chain issues are persisting, and there are growing concerns about a potential recession. Buffett, with his decades of experience, is likely looking beyond the headline numbers. He's probably seeing the potential risks on the horizon, risks that could lead to a significant market downturn. One of the big concerns is inflation. While some inflation is normal and even healthy for an economy, too much inflation can be a real problem. It erodes purchasing power, squeezes profit margins, and can lead to higher interest rates. Then there's the issue of government debt. The U.S. national debt has ballooned to over $30 trillion. That's a number so large it's hard to wrap your head around. While government debt isn't inherently bad, too much debt can lead to economic instability and potentially trigger a market crash. And let's not forget about global economic tensions. Trade disputes, geopolitical conflicts, and the ongoing effects of the pandemic are all adding uncertainty to the economic outlook. All of these factors combined create a complex and potentially volatile economic environment. And in times of economic uncertainty, cash is king. By building up his cash reserves, Buffett is essentially creating a financial bunker, a safe place to weather any economic storms that might be on the horizon. The psychology of the market. Right now, we're seeing signs of extreme optimism, maybe even euphoria in certain parts of the market. Meme stocks, cryptocurrencies, NFTs. These are all symptoms of a market that might be getting a little too exuberant. It's like watching a party that's gone on a little too long and everyone's had a little too much to drink. Buffett, being the wise old owl that he is, has seen this kind of behavior before. He famously said, "Be fearful when others are greedy, and greedy when others are fearful." Well, looking at the current market, it seems like a lot of people are feeling pretty greedy right now. This is where Buffett's contrarian approach comes into play. While everyone else is jumping on the bandwagon, Buffett's quietly stepping off. He's not caught up in the FOMO, fear of missing out, that's driving a lot of investment decisions right now. Instead, he's patiently waiting on the sidelines with his mountain of cash. It's like he's the designated driver at this wild market party, staying sober while everyone else is living it up. But here's the thing about market psychology. It can turn on a dime. All it takes is one piece of bad news, one unexpected event, and suddenly, that euphoria can turn to panic. And when panic sets in, that's when markets can crash. By building up cash reserves, Buffett is not only protecting himself from potential downsides, but he's also setting himself up to take advantage when fear does eventually take over. When others are scrambling to sell, Buffett will be ready to buy. It's a masterclass in emotional intelligence applied to investing. While others are getting caught up in the excitement of a bull market, Buffett's keeping his cool, playing the long game, and preparing for all possibilities. So what do you think? Will the market crash or will it remain the same? Share your thoughts in the comments section, and don't forget to subscribe to the channel.